been able to focus or hone in on the risks areas. And from the perspective of a bank regulator, I was a bank regulator with the Office of Control of the Currency, our regulations were not very good, and they look, today's regulations do not look anything like the regulations and the inspection procedures we're using. But a main improvement is the use of an assessment from the perspective of a business to take a look at where their unique risks are, and from the perspective of a regulator to hone in on and look at the assessments and see what's happening in a particular company. Okay, these are general purposes. I think one of the most important one is to allocate a firm's resources, because a firm really needs to look at the resources and make sure what they are doing is effective and not utilize scarce resources in the wrong way. Okay. So who should conduct an assessment? This depends largely on the kinds of businesses and the size of businesses. If it's a very large firm, certainly one would want to look at the resources of a consulting firm. But we really want to have people providing advice that look at all areas of the business, because what you'll see in terms of risk is that risk covers many, many aspects of a business operation. Full support of upper management is crucial. And the main focus in conducting an assessment is that you want to avoid risks. And some of the major risks that companies, financial institutions, and other companies face is reputation risk, transaction risk, and compliance risk. And upper management should be concerned about these risks and what it means to the liability of their company. And as you can see, it covers financial conditions, it covers reputation, and it covers liability. The liability should the firm be found to be violating laws. In terms of inability to carry out a transaction, an example would be where a particular company would be involved in a very large project, but should it be tainted with money laundering, then most of the resources and what's gone into putting that project together is lost.
Okay, and I need to mention one thing now that everybody is here. We will be recording this meeting, so just so everyone is aware.
Okay, this is a schematic presentation which shows us where we're going for the rest of the presentation. This is a summary of all the areas we'll be covering in the next 20 minutes. We'll first take a look at the top grouping, and this is the risk areas, the products, services, and delivery channels. The geographic risks that has to do with both where you do business and where your clients come from, and then other risks that are relevant to your particular kind of business. Finally, the risk of the individual clients for your business. Then we look at the approach. It's a three-step approach. First, you review the risks in your operations. Then you create risk reduction measures. And finally, you implement those risk-based measures. So again, identifying. Okay. For purposes of conducting an assessment, you want to separate out first business-based focus, that is the operations, and the clients. And after a while, when you're going through this particular assessment process, you'll see where the business operations and the clients converge in terms of determining the riskiness of a particular situation. So in conducting the assessment, you want to identify your clients, your products, services, transactions, and geographic areas. And we'll go into the geographical areas in detail. Finally, you want to, in terms of the assessment, when looking at the client, determine what services and products that the client uses, because the products and services can determine, with respect to this client, how risky the client is. Some services and products are not so risky. Others, combined with the client, produce a higher risk. I just wanted to point out that working closely with other companies in your business means a higher risk, because you can control your particular company in terms of its compliance aspects, but you're limited in terms of how you can control another company, unless, of course, you have a certain number of provisions. For example, I'll use the example because I'm a bank examiner, correspondent accounts between banks. In that case, the banks will agree on certain principles, certain programs, the way in which things are being conducted. So again, it's a higher risk if you're working with another company. So geographic areas, they really cover from the local neighborhood all the way up to dealing with foreign countries. And this may be one of the more difficult for a particular company undertaking an assessment, one of the more difficult areas to focus on. But there is assistance, and there are a large number of organizations around the world that have drawn up lists of the so-called bad guys, or bad countries, or bad companies. And if you go on the internet, you can find out the kinds of things that you need to know when looking at clients. The Financial Action Task Force, State Department has an INSER report, and so on. The Know Your Customer website's excellent for evaluating countries. And the list of jurisdictions subject to sanctions of the U.S. Office of Foreign Asset Controls, they also include companies and individuals that are listed that you do not want to be doing business with. So you can avail yourself of those resources. In terms of risk, there's always something about your particular business that has a unique risk, and you'll know that from looking at your business and conducting your business. So you have to factor in those things there. Unique risk associated with the kind of business that you're operating. Branches, oh, if we want to go back to that one, the structure is also important. If you have a large operation, number of branches, satellite offices, large number of sales agents, this is one more area that you have to control to assure that the risks of money laundering are not being carried out beyond the headquarters. So if you're an organization with a large number of branches, then this is an area that you've got to look into, particularly with respect to applying controls. All right, in terms of the risk process, there are a number of different formats that you can use, but basically you're just looking at first an area of the company, and then you will determine from looking at that area, you will assign a risk, and you should be able to explain that risk, and then you'll draft mitigation measures. And in the next 10 slides, we'll go into both the risk area and we'll suggest mitigation measures for those risks. Because we'll first look at business operations. Okay, so on the left-hand column, we're talking about all factors in the business, the products, services, delivery channels, very important. How do you provide your service or products? And the geography. And then you'll look at that. I gave the first example down with respect to mandatories. This is a high risk if you don't have complete control or knowledgeable of this particular person. There's a greater risk. And here are some of the mitigation measures. Increase awareness within the firm. Look at client files to find out if this particular mandatory that you have a contract with is doing his job in terms of customer due diligence. Okay. Another high risk area is when you don't have face-to-face relationships. This makes it more difficult to know who you're dealing with. So this is generally a high risk. Uh, if, on the other hand, there's a strong knowledge of the client, the history of the client, then you can determine it as a low risk and no mitigation measures are required. Once again, the assessment process is to just target on high risk areas and not use scarce resources that the business had to look at too many potential risks. Another high risk is with respect to the sales force. If there's a high turnover, then they may not have been trained properly. They may not have had the background that you need for looking at money laundering risks. So this would be high risk, high turnover in the sales. Now let's look at the clients. And once again, the riskiness of the clients can many times be determined by the services and products that they use. In terms of geography, where do they come from, where are they located, where does the financing come from? Very important. And I'll talk a little bit about that. I think we have an example of one of the mitigation measures that has to do with financial institutions. Okay, we could move on to the next slide, I think. Okay, here's some of the mitigation measures that can be taken by a business. Increase the awareness of high-risk situations, provide adequate controls, and of course, create that culture of compliance and increase due diligence requirements, specifically when a high-risk customer is identified. Okay, this is an area that's going to require more work for the company in terms of when there is a higher risk customer. These are some of the steps that should be taken under customer due diligence. Ownership is a very important area to look at. Okay, here are some questions that you want to answer in terms of looking closely at high-risk customers, where the business is organized, the trade areas, the operations, explanation of changes in companies' use and products. This is a real telltale sign when a particular client, a business begins to use other services and products that were not anticipated when they were first establishing a relationship with your company. And considering good consideration should be given to establishing profiles on the customers that answer a lot of these questions, so that you can go back and look at a profile of a customer if you think something doesn't seem to be right and perhaps a risk for money laundering. Customer identification requirements are very, very important. And as an ongoing process, there should be, at the appropriate time, people in your company to go back and look into the files to see if the proper information is being maintained and updated. Training is also extremely important for new staff. And of course, if we go back to the other slide, I wanted to point out that it's important. Oh, move up a little bit. It's very important to keep up with the latest kinds of money laundering schemes that could be perpetrated on your particular company. As you know, money launderers continue to change their patterns when the authorities are getting very close to their operations. So there's always a new kind of a scheme that is perpetrated on the business community. Oh, I wanted to mention something. It's a very good example. In the United States, in Virginia, there's a group of compliance officers that meet once a month in Northern Virginia, and one of the major topics is a particular money laundering scheme that they may be seeing. Job descriptions is important also. In terms of a business operation, when there are high-risk transactions, you must have a mechanism to keep upper management informed. And when it's appropriate with respect to high-risk customers, a procedure whereby who signs off on it. You have to be knowledgeable of the customer's motivation. Okay, these are the major conclusions. The assessment can be better utilization of your company's resources to prevent money laundering and liability. And of course, you're contributing to fighting money laundering and terrorist financing, which has a very, very disastrous impact on countries in terms of economics, providing social services, and moving countries ahead. This is just one more slide. I wanted to make a distinction between a business, a general business, and what is required of financial institutions such as banks, securities firms, money service businesses, casinos. Casinos are considered a financial institution in the United States. But for a general rule, most companies should have policies and procedures that are set up to reduce the risk of money laundering in the company, and they must have training. With respect to some of these other companies, these other financial institutions, regulators insist that they have a compliance officer, they have internal audit, and they have testing. And testing is no more than, as we discussed a little bit earlier, going back and looking at transactions, going back and looking at the profiles of the clients to see if they're essentially using the products and services that they had initially intended to, or that they had announced when they first came on board with your company. Again, senior management commitment is essential, establishing the mitigation measures, and then again, training.
Great, so we're going to move into the question and answer portion of this presentation. So everyone, if you can see at the bottom where there is a space where you can submit questions to Mr. Wright, feel free to go ahead and start that process now.
Okay, I think earlier when we were talking, getting ready to make the presentation, we thought a very appropriate question would be, from your association or from your business, do you think that this risk assessment procedure, the process that I've identified, can be used in your company, or are there some aspects of your company or your organization where we need to perhaps modify this presentation?
Great, so we just launched a poll and feel free to vote within the next minute. We have 50% completion so far. That's pretty good.
Yeah.
So we're going to give you guys about 20 more seconds, and then we can show you the results in real time. Okay, it looks like we had a 100% yes, my industry can use this assessment.
Good.
Great. And we also were talking right before this presentation about adding another question And that question was, what kind of organization do you represent if you're one of the members of this meeting? So the three options that we have are you an individual business, a business member?
Laura, you're on mute.
Oh,
Can you hear me? Can you guys?
We still can't hear you. But we do have, Laura, while you figure out your audio, we do have one question so far from Ben Schmidt. He says, what can regulators do to prevent money laundering occurring through networks of shell companies in foreign countries? So Jim, did you,
yes.
again, the question is, what can regulators do to prevent money laundering occurring through networks of shell companies in foreign countries?
Yeah, if I could just give an explanation for those who are not aware of how the shell companies operate. A deposit, illegal deposit could be made in one bank. You can move from that bank to a shell company A, shell company B, C, D, E, and eventually back into another commercial bank for perhaps deposit into criminals' accounts or for the purchase of real estate or something like that. So the answer to the question is that countries must adopt very strong beneficial ownership declarations, declaring the benefit, the true beneficial ownership, and that is the key. Many countries have weak laws, and you cannot determine when doing due diligence who the actual owners of the accounts, who the actual owners of the corporation are. So it's beneficial ownership, clear identification, and that calls for national regulations. In UK and other European countries, the US is approaching that point right now, but that's the key, so that you know what the makeup is of these different shell companies.
Great. So we got another question from Alan Mukasira, and they asked, in a value chain, how do you do a risk assessment of all of the players, given that you cannot work with all the players directly? They do their business in an agricultural value chain.
That's a good question. It really goes back to that original question that I had, because in terms of the developing a presentation, a methodology for a multiple group of companies, it's a bit difficult. But if we're looking at something like value chain, then you're looking at a whole host of players that probably need a subset of this particular presentation. You probably need to focus in on how agricultural products and services and the many players are, and how they need to be vetted. So that could be a separate approach just on the agricultural side.
Great. So if anyone has other questions, please feel free to submit them now. And in the meantime, we can launch that poll that I was mentioning earlier. And that was just asking the type of organization of our participants. So those types, like we said before, was individual business, business membership organization, or anti-corruption organization. And the poll should be live now. All right, we're at 65% participation already, so we'll give you guys another 15 seconds and then share the results. Okay, ending the poll now. So it looks like out of our participants, 44% are from individual businesses, 25% are from BMOs, and 31% are from anti-corruption organizations. So we have a really good amount of diversity here in terms of the type of organization. Now we're going to get back into our question and answers, so feel free to ask questions. Anyone can ask questions, even CIPE Africa staff, if they have any questions for Mr. Wright. So in the meantime, when we're seeing if there's any other questions, Mr. Wright, do you have any examples of when you've taken one of these methods like the risk assessment and kind of put it into action?
Well, the regulators like it because when they go into security firms or money service businesses or banks, they can quickly determine where the risk is that in that particular entity or that company, and then they can see if the proper mitigation measures are being undertaken. But I think from an individual company, going back to some of those factors of the liability that you have, the risks, those three different risks, I think that's why it's important. As a company, you don't want to be facing those risks. So it's worth it to take the extra step and resources to conduct the assessment. Another thought occurred to me that as a compendium to something like this, it may be important to send out lists of typologies that transcend industries. That may be helpful.
Great. So we got a question from Lars actually, and he asked, can you give us some examples of industries or situations that are more susceptible to money laundering than average?
Well, the financial institutions, the money service business, the casinos, the insurance companies, securities firms, they're big. I think more and more people are beginning to focus on the extraction businesses. And more recently, I personally have been focusing on developers, real estate development.
Yeah.
Many countries now are reaching the point where they're seeing an increase in development, real estate development, and that is a big area that needs a lot of attention. I'm not talking about purchasing homes. I'm talking about big developers obtaining funds from other countries to develop residential developments or other kinds of developments. So that needs to be looked at very, very carefully because, first of all, many of the cases involve the movement of state-approved or state-owned properties going into the private sector to be used for these developments. So that could be a real big area to continue to focus on, is how to fight that from a regulatory, from a country's perspective. I was talking to folks from Vietnam last year, and they are faced with that very big problem as to how to regulate development with respect to investors from outside the country coming in and developing and using money laundering. So I think the extraction industries and the development, real estate development, are two areas to watch very carefully. And of course, wildlife management too has been something that's been, with respect to Africa, a very important area to look towards in terms of money laundering, how it plays.
So we got a follow-up question on that, and they said, can you go through some risk mitigation examples in these industries?
Yes, let's see. Let's take the real estate industry first of all. In terms of that, you would want to have more due diligence done on these particular kinds of deals, and not only looking at the realtors, but also looking at the attorneys and other kinds of people that are involved in that process, the financing of the real estate. Yeah, the extraction industries, it's an area I would like to get into. I don't have a good, strong background in looking at money laundering, but it is a big problem. My colleagues are focused on it. Casinos are another area too. There are many, many ways that funds can be laundered through casinos. And unfortunately, in many countries, they're very loosely regulated.
Hmm.
The money service businesses, of course, have always been a source of money laundering, and they are, for the most part now, more regulated money service businesses. And but you know, in terms of moving forward, international real estate transactions and development, that's something that countries, because so many times it's appropriating state-owned land for these particular projects, illegally appropriating state-owned land.
And did you have any examples for the wildlife that you mentioned a second ago?
You know, I do know a lot of organizations, not only in the United States, but international organizations do an extremely good job of tracking the activities of illegal wildlife poaching. So one of the most important things is for countries not only to have good, strong regulations and enforcement provisions, but the second thing is that they need some sophisticated systems that they can adopt that can track the movement. Many times that's lacking in countries. So tracking is important too.
Cool. So we got a couple more questions. The first person asked, what are the key risk indicators when dealing with a shell company?
I guess the first indicator would be very vague information about that particular person who's approaching, say, a bank. Vague information, background information, and you know, not meeting the standards of proper due diligence. So that would be the first time. Quite often, straw men are used in those situations. The real beneficial owner is not involved in the transaction, but uses other people. The movement of the funds through a number of different kinds of banks or shell companies.
So we got a follow-up from the question earlier where somebody said, do you have any examples of money laundering in an Africa setting in particular?
Africa, well, let's see. It's been some time since I've been in Africa. You know, I don't have a strong background in the extraction business, but I think that that is a big area that needs more attention in terms of being able to follow the money, so to speak, that the extraction industries. That's big. Yeah, I would say one would want to press governments to do more in that particular area in terms of the ability to enforce regulations, establish regulations, and investigations on the extraction industries. If you take, for example, petroleum development or diamonds or other ores, and what that is doing to an African country, taking away valuable resource that could be used for, you know, the common good in that country. So I would say the key there is higher enforcement, money laundering regulations, tougher money laundering regulations, and you know, a tougher regime, so to speak.
Yeah.
Yeah, I just wanted to follow up. The other area is you have to have strong enforcement, and you have to have judges, investigators, prosecutors that are knowledgeable of the details of these crimes so that they can do their job. So there's still a need for more training and more resources in that area.
And maybe a follow-up to that is that we have a number of sort of smaller businesses in our audience. And especially now that, you know, we're experiencing a pandemic globally, there's not a lot of extra funds to go around. And sometimes it seems as if the first thing to get cut are these sort of anti-corruption, anti-money laundering, you know, practices. So on that topic, what would you say are ways to go about this process while still being cost effective and time effective?
Well, in the United States, over the past few months, there has been quite a lot written. There have been virtual conferences focused on the fraud aspects, not only looking at loans and businesses, but employees and employee relationships and the health industry. There's a whole host of areas that need more attention, more resources, more investigations. You'll see in the coming months and year or two, a lot of cases being brought in those different sectors, the loans to small business, the employee employer relationships and possible fraud on both sides of that, the medical supplies. So all of these fraud cases, all of these aspects during this particular time, it's very common for this fraud to expand tremendously. And it's happening in every country too. Every country takes measures to counteract COVID-19, but at the same time, more and more fraud is being perpetrated.
Right. And for organizations that have more limited funds, what would you say are sort of the best ways to make sure that there's strong, procedures in place to respond, but also, keeping in mind that some businesses don't have a lot of money right now to devote to anything?
Yeah, I would hope that some of the businesses that are looking at this assessment could take that to some companies and say, hey, look, you have a liability here. We can come in and we can do this assessment for you, and you're going to look much better, and your risks are going to be lower, and your liability is going to be lower. We can do this for you. So, they could take this program and move into some of these companies and make, it's a new service that they can offer.
Absolutely. Great. So next question, with the transnational nature of business and the lack of transparency of beneficial ownership information, how does one go about doing proper due diligence on customers?
That's a very good question. And there are a host of organizations that actually do have sound information on beneficial ownership that you can tap into. There are these organizations, yeah. LexisNexis and Thomson's Reuters, and many of them provide services that you can do some background on the beneficial ownership aspects. And some countries are developing registers, very important step for the country to establish registers where all companies must provide minimum information on the beneficial ownership, and it's based on the percentage of ownership in the particular company, made up in the background on these particular individuals. So
great. Okay, we do have a number of extra questions. So somebody asked, what are the challenges that are common while doing the risk assessment for money laundering, and how do you go about them?
I think the challenges, first of all, are probably the same challenges that anyone would encounter when being a consultant to a business. There's an institutional reluctance to change, and you meet opposition there. If you don't get 100% commitment from upper management, then that is a problem for you also. But I think a problem for me may be if I went to Nairobi, Kenya, and made a presentation to a group of certain businesses, I would not understand their business completely. And there would be aspects that would have to be explained to me so that I'd have to make an evaluation. Well, does that sound risky? Or, so that's something. It reminds me of something else too that I didn't mention during the presentation, and that is, and this goes back to my role as a bank examiner. Whenever there's a change in a company, regardless of what the change is, it could be a new product, could be a new service, could be new management. There's risk, high risk. So you have to approach that. in terms of doing an assessment. That's what you want to be looking for. Changes, new products, services, changes in management, all these things automatically trigger a higher risk.
That's a great point. Okay, so next question, somebody asked, can you share your opinion on the introduction of a third party into the payment process in settling international trade?
You know, that's an area, the third party area is, I was asked to look at a couple last year, look at a couple of cases from Eastern Europe, and we had to look at the possibility of trade-based money laundering. And it is an extremely difficult area to investigate, to trace, because of the paper trail and the nature of international trade transactions. But there are some good conference material and reports that have come out this year that lend itself to better understanding how trade-based money laundering is conducted, the sort of schemes. And that would be helpful. I don't know if Lars would be amenable to try to get maybe something out that would identify some of these trade-based money laundering reports, but it's an extremely difficult area to investigate, the most difficult area to investigate.
Great, so we will follow up on that. Next question somebody asked was, what would be the key areas for an insurance business?
Well, insurance businesses have a number of different kinds of, it's usually the purchase of insurance for investment purposes, or it would appear it's an investment purposes. So they will buy policies and then quickly pay them up and turn them back in. They'll have them for a short period of time, and then they will obtain their money back with some penalty. So it's the investment side. There's some liability issues too, where, you know, in terms of ships and other kinds of where, you know, there's fraud mixed in with money laundering. But basically in the insurance industry, it is the purchase of investment grade insurance and then turning around and canceling the policy and getting the substantial amount of their money back.
Great. So next question from someone, they asked, what are some of the key areas that internal audit should focus on when assessing ML/TF?
Okay, I'd say the quick answer to that is two things. Look at the internal program of the particular company. What kind of policies and procedures does the company have to fight money laundering? And then the second thing is, you want to see if that particular company is actually implementing those policies and procedures. So the second part of auditing is to take a look at different transactions or different sales, different kinds of products and services, and see if in fact the policies and procedures are being applied. So from an auditing standpoint, first you want to see what do they have in terms of policy and procedures. The second thing is testing, looking in files and finding out, are they really doing what they say they're doing?
Awesome. So next question, somebody asked, could you please give some examples of what are adequate controls in order to mitigate risks related to money laundering?
Well, we covered some of them in the presentation. The controls would be, first of all, can you identify high risk versus low risk? If you have high risk people, high risk clients, then do you have a process whereby you conduct enhanced due diligence, background checks, and do you monitor those high risk individuals? So that's a real big part of. And the second thing is the training. You need to have training for your employees so that they can recognize a high risk customer, and B, most importantly, the schemes that could be perpetrated on this kind of business. That's what's important about the training. And of course, the training that they know their job and what they need to do if they see something. What is the proper procedure? I gave that example of where you have a large transaction, a client that's determined that there's a lot of risk there. You've got to elevate that to upper management to make a decision.
And would you say there's any controls that should be put in place during the hiring process, or is it more something that you'd recommend later on people focus on in terms of trainings and sort of changing the cultural mentality?
That's a good question. Is there a system in the country that identifies the bad apples? That would be excellent. When you're hiring people, can you find out that this person, is he or she on a list or this or that? But the other thing is, have they had training before? That would be good if they had AML training before. So you've got to be extremely careful. And then, if you're in a very high risk business, then you want to do proper due diligence on who you're going to actually allow into your company. So
Yeah. Okay, next person. Can you share your opinion on the sudden introduction of a third party? Oh, we just went to that one, I think. Okay.
actually, there is something else that I did want to say, and I didn't put it in the presentation, but there's a whole host of issues that involves a third party. And it's the third party, if you're a business from, let's say, France or Germany or the United States, and you are coming into a country to do business, you interact with third parties. Many times they are not the most upright, upstanding. They are suspect. They are suspect. And, in every country, there is a cadre of these folks, and you have to be careful about how you deal with them, what services they're providing for you. So that's a big area too. There's not a lot written about it, but practically every country has those people as a profession that companies are dealing with, third parties that are suspicious. But third parties have to, A, be vetted, and B, like I gave the example in the corresponding banking, you've got to have certain agreements with them that they will, in fact, conduct themselves and they will abide by your company's policies. So that's important too.
Great. So mindful of everybody's time, we're going to wrap up in about 5 minutes. So if you have any final questions, submit them now. We have 2 left right now, so if there's any others, feel free. So the first one is, what role do you think business associations should play in anti-money laundering? Is this limited to vetting members, or is there something else that chambers and associations should be doing?
I think chambers and associations should be doing a lot in terms of pressuring governments for the correct regulation in the area, not only of money laundering, but fraud in other areas. They should be pressuring governments, and I think that's the first. The second is, I think it's important for an association to spread the word on the types of money laundering schemes that could be perpetrated on each kind of business. That's very helpful because it's an ongoing process of keeping up with the money launderers. So associations can do that. A third thing I think they could do is, in every organization, I've seen this from the very beginning when I became an examiner. Every organization, there's someone that's going to take the leadership. They're going to decide, there's no requirement for this, but I think it's good for my company. I think we're going to do this. Okay, we're going to set up a group. They're going to look at our operations, and we're going to have an assessment, and we're going to have a good program to fight money laundering and fraud. You could take those particular companies, the shining companies, and let them come in and make a presentation to the rest of the group and explain how they went about doing it, that it wasn't so bad and what their benefits are. There's always, every organization has somebody that's decided they're going to go and do something a little differently, go beyond. So find those folks, or if your organization doesn't have a particular company like that, then take the assessment and find some people who are willing to help out to do the assessment and make a model. And then you have a model, you have one company in your organization that did it, and they could say, yeah, this took a lot of time, but we're glad about this. We found out about this. This was a big surprise for us, and we think it's something good. So you might want to try that.
So we got a question asking, how can they raise their risk appetite?
You know, that's an excellent question. And it comes up time and time again. It's an excellent question. In banks, it's been around since I started working as a bank regulator. You can accept the risk as long as you manage the risk. If you have some high risk clients that you want to continue to deal with because it's good for your business from a business standpoint, then institute the proper controls and oversight. If you have the proper controls and oversight, then you're managing your risk. So that's pretty much it.
Great, we got an additional question now. So somebody asked to follow up on earlier discussion, are there transaction risk indicators that you would like us to watch out for when conducting a risk assessment?
Yeah, I think it would be two things. First of all, it would be a transaction that's atypical for that client. So you see a client that normally is buying your products and services, and now they've moved into something entirely different. And that's a bit of a red flag. So you want to do that. The second thing is the geographic. You're dealing with people in different geographical areas, which makes customer due diligence even more important. So those are the two major triggering. You get somebody, you sounds like a good client, a new country, and you don't know that much about it. You've got to do your background check on the country and the individual. So those two things. But quite often, a good telltale sign is the change in the methods that the client uses in terms of using your products and services. They're not with there, and that's why it's important to establish profiles for these different clients.
Great, so we're coming up upon 10 o'clock now. This has been a great presentation, a lot of really awesome information that you went through. Do you have any closing remarks for the audience?
Well, if one of the associations wanted to take this and if they're able to get a member that would be willing to go through this process, I think it would be very helpful to the organization to give it a try.
Great, well, thank you so much everyone for joining. This was very informative. I hope everyone on this call can catch us back next Wednesday for another association's presentation. And I hope everybody enjoys their Wednesday. Thanks, everyone.